Today, what you're going to hear are these two REITs. I'll give it to you right away. The first, Mapletree Pan Asia Commercial Trust. The second, Keppel DC Reit. According to my Telegram group poll, which you can join with links below, these were the top two names to cover. So as I've suggested on the thumbnail, I'm actually not buying more into them, but based on various reasons. I'll cover MPACT first, which I think did relatively okay, but the same cannot be said of Keppel DC Reit. If you are curious, continue watching. Hi guys, welcome back. Without further ado, let's start with Mapletree Pan Asia Commercial Trust. Recently, they've announced their third quarter 2024 earnings results. You would see over here in this summary table that net property income actually increased year on year, correct? Pretty good, but as compared to a year ago, net finance cost has actually inched up by quite a bit to $57+ million. This has weighed down on the distribution per unit DPU to 2.2 cents for this quarter. As mentioned on the bottom right, you would see that Sing dollar appreciation against Hong Kong dollar, Japanese yen, and renminbi have all impacted the DPU. But the interest rate spike is last year's story really. What we need to focus is quarter on quarter performance comparison, correct? So I've actually done the homework for you and pieced them together first, second, and third quarter to see in a bird's eye view what is exactly going on with this REIT. We would see that gross revenue has increased, which is good, but due to higher operating expenses, net property income has dipped slightly as compared to second quarter 2024. The good part, however, is net finance costs when compared on a quarter-to-quarter basis has actually stabilized. I think moving forward, I'll be monitoring this a lot. Hopefully, if interest rates do not climb up further, net finance costs can stabilize for most REITs and the DPU can start climbing again based on net property income growth. When we piece them up together, I think it's fair to say that the forecasted 1-year DPU for Mapletree Pan Asia Commercial Trust would be around the 8.8 cents. Whether it's going to be higher or not, let me explain to you its key assets. And before I get there, help me smash the like button because it's taken our team hours to prepare this presentation for you and hopefully it makes you a better investor. I've also done the homework to piece first, second, and third quarter results based on these individual assets. So if you're new to MPACT, let me explain to you how to interpret its reports moving forward. Based on 80-20 rule, let's focus on the three particular important components of MPACT. The first is the orange bar at the bottom, the biggest one. That's actually Mapletree Business City. If you work around there, you're definitely very familiar with it. Google is a key tenant in that business park. You will see that performance has been relatively flattish, correct, for Mapletree Business City. So I see it also as a stable asset. The next asset to focus is actually the turquoise one, which is Vivo City. That, in my opinion, is the crown jewel. On a year-to-year basis, Vivo City has grown tremendously. And moving forward, with Chinese tourists expected to come in second quarter, I think this will definitely help traffic in Vivo City. Comparing first, second, and third quarter, you would realize that second quarter actually had a higher net property income number for Vivo City, correct? At $44.7 million compared to 44.2. But again, that's due to seasonal sales. Then the next one to focus is the yellow one, which is Festival Walk. Festival Walk is an even bigger mall than Vivo City and is housed in Hong Kong. As we know, Hong Kong tourism has suffered even worse than Singapore, I guess. So this recovery has been very slow. The good part of seeing this when we compare quarter-to-quarter is that recovery is still intact and hopefully this will contribute more to the overall net property income. MPACT actually has currently a very high debt to equity ratio of about 41%. That's actually similar to CICT, which is one of Singapore's biggest REITs also. So the usual question as investors is, hey, are there ways that you can cut down on this leverage or not? Because you are transiting to a possibly high interest environment. And when I look at analyst report, I was happy to hear that management has acknowledged investors' feedback that gearing is not at an ideal level and they are open to explore divestment opportunities to bring down the debt equity ratio so that costs drop and hopefully near-term dividends per unit can actually climb. If there's a buyer interested in M Tower, I'll think why not? Because all along it has some tenancy issues. Or if there's a buyer for Mapletree Anson, which is pretty stagnant, I also think it's worth to consider. When the borrowing dropped, that's where also MPACT has room to acquire distressed assets if there is any. And pertaining to this point, I like to tell management also, I'm not a fan of Harbourfront Centre. I think it's not doing very well. My personal opinion is please do not acquire this from parent. So all in all, I think MPACT has done pretty well, and at current price is about a 5.5% dividend yield. The reason I'm not buying is because I already have quite a lot of it. It's my third or fourth biggest holding right now, and I'm quite happy to hold on to it. Let me know your thoughts also in the comment sections below. And now let's move on to Keppel DC Reit, which was actually the highest voted to do a quick review on. Let me share with you a story of what Keppel DC Reit has went through so you understand the ups and downs as well as why I got invested in the Keppel DC Reit and what my thoughts of it currently. Keppel DC Reit in 2021 expanded into China via some acquisitions of data center in Guangdong. As you can see, there's Guangdong DC 1, Guangdong DC 2, and partially completed Guangdong DC 3. If I'm not wrong, they have first right of refusal for more Guangdong data centers, but I guess no investor is very keen on buying more of these assets, and I'll tell you more in a while. Guangdong Data Center 1 was actually acquired at a 7.8% discount to valuation. So again, it's like if something is cheap, maybe something is wrong. I didn't see it that way, and unfortunately it didn't raise red flags in me. I should make my purchases in July and August of 2023. Never mind that, let's move on to October 2023. This was a fateful moment because it's been raised that the tenant, Neo Telemedia, was actually reporting big losses. When tenant is making losses, the logical reaction will be, hey, maybe they can't pay rent already, right? And that's why I actually spooked the markets, which caused a correction of 16% to Keppel DC Reit's share price. It's also worth noting that back then, it was just a hypothetical scenario, and it's mentioned that Keppel DC Reit continued to receive full rental payments. Citi's research report even mentioned that the share price dip could be due to concerns of new acquisitions in Keppel DC Reit's pipeline. Continues to receive full rental payments? Let's dissect that because news came out just 2 months later in December 2023 that indeed this tenant has failed to make payments. Explicitly mentioned is they have paid installments up to October but failed to make payments due at the end of November. Does that sound like full rental payments? To me, I feel a bit misled and a bit disappointed because as per this announcement, it's quite clear that full rental has not been received for 4 months, including their coupon payment. It was only installment payments. Wow. So to any layman, I think it's quite easy to understand. If someone is paying you installment, they are probably in financial trouble, right? Why wasn't this explicitly mentioned? I'm also a bit disappointed. If we look in terms of financial performance, you would see that property expenses for second half 2023 is factoring all these rental arrears. And if you dig in terms of financial reports, you would see that the loss allowances for doubtful receivables is $10.5 million. This in turn hurts the dividends per unit, which plunged from 5.16 cents to 4.332 cents. Now the $1 million question is this loss a one-time loss or a recurring loss? My hunch is it's going to be a recurring loss and that a new tenant will need to be found eventually. That's why I would like to rely on this CGS CIMB report that has painted expecting the worst for Guangdong DC 1, 2 and 3. They have assumed also that if there's no rent contribution from Blue Sea for the entire financial 2024, Keppel DC Reit will take over Guangdong DC 1 and 2 onwards and gradually lease out the asset. Mentioned also, the management has said that it reserves the right to terminate the purchase of Guangdong DC 3 and will consider divestment of KDC 3 as a potential option. With this scenario planned in, CGS CIMB has estimated that the DPU could sink as low as 8.44 cents for financial 2024. Therefore, they have given a target price of $1.88, which unfortunately I disagree. Again, that's not investment or financial advice, it's just how I interpret what I read right there. Let me know if you have a different interpretation. So far, there's no impairment on these Guangdong data centers yet, but it will come in future. even though the dividend yield is 5.2, 5.3%, higher than before, I'm personally not too keen to take on that unknown risk as of now. With that, I'll start from here and invite you to this previous video I had on the top 5 dividend stocks to invest for 2024. Check it out, I'll see you there too. Take care as always, goodbye.